Hey everyone, welcome back to The Explainer. So if you're interacting with crypto over in the UK, you are absolutely going to want to pay close attention to this one. Looking through these newly dropped HMRC draft policy papers from July 2026, it looks like a massive shakeup is coming in 2027 for how stablecoins and DeFi are taxed. You might be wondering why our bull mascot is sporting sunglasses today. Well, surprisingly, some of these changes are actually welcome news, though they definitely come with a few catches. Let's explore what's in here.
All right, here's a quick look at our agenda for today. We'll start with the 2027 tax shakeup, then dive into stablecoins and the CGT exemption. After that, we'll hit the Forex Trade-Off, unpack the new DeFi no gain, no loss rule, and finally wrap up with some practical takeaways for 2027. Let's get into it. Section 1, the 2027 tax shakeup. Let's look at exactly who is affected by this and when. Just to give you an idea of the sheer scale we're talking about here, check out this number. 1.2 million. HMRC estimates that roughly 1.2 million individuals in the UK are currently making stablecoin transactions. That is a massive chunk of the investing public. So we're not just talking about a niche policy for a handful of high rollers here. This is going to directly impact everyday retail users. And it doesn't stop there. On top of those stablecoin users, you've got an estimated 700,000 folks using crypto loans or providing liquidity to automated market makers. So if you've ever so much as touched a liquidity pool, these incoming changes, they are going to radically alter how you handle your tax reporting. Now, timeline is absolutely crucial here. Deep breath. You don't need to scramble and change your 2025 or 2026 tax returns just yet. But we absolutely need to prepare now for these changes, which kick in come April 2027. If you're operating as a company, mark April 1st, 2027 on your calendar. For individuals and trustees, it aligns with the standard tax year start, so that'll be April 6th, 2027. Okay, quick reality check before we get too far ahead of ourselves. What we're looking at from these July 2026 policy papers is still draft legislation. It is literally not law yet. It's part of the upcoming finance bill and, has to go through the whole standard parliamentary process. But HMRC has made their intentions incredibly clear here, so we really need to know what's coming down the pipeline. Moving on to Section 2, Stablecoins, the CGT exemption. Basically treating crypto a whole lot more like regular fiat money. So, up until now, HMRC has basically looked at a stablecoin the exact same way it looks at Bitcoin or an NFT. Just a standard crypto asset, right? Meaning you get hit with capital gains tax the moment you dispose of it. But from 2027 onwards, what they're calling eligible stablecoins will be treated way more like fiat money. Now, to be considered eligible, the coin has to maintain a stable value against a fiat currency and be backed by real-world assets held specifically for that peg. So those complex algorithmic stablecoins, they probably won't make the cut. But fully backed USD-pegged coins like USDT and USDC, they absolutely will. For individual users, disposing of these eligible coins is going to be entirely exempt from capital gains tax, a real game changer. Which brings us to Section 3, the Forex Trade-Off, because of course this new exemption is a bit of a double-edged sword. A completely tax-free stablecoin sounds like pure, unadulterated good news, right? Well, it mostly is. But let's look at the foreign exchange dynamic this creates. Imagine this very common scenario. You're holding $10,000 worth of USDT. You just sit on it for, say, 6 months. The US dollar value hasn't moved a single cent. But let's say the British pound takes a hit and weakens against the dollar, moving from an exchange rate of 130 down to 120. Suddenly, your 10 grand goes from being worth $7,692 to $8,333. You literally just made a 641 pound gain in sterling purely because of currency fluctuations. Now, check out the stark contrast in how that exact scenario gets taxed. Under today's rules, HMRC taxes that 641 pound Forex bump as a capital gain. Yep, you owe tax on money you essentially made simply because the pound had a bad month. It's frustrating. But after April 6th, 2027, that entire gain becomes completely exempt from CGT. But hey, remember that title? The exemption definitely cuts both ways. Let's flip that scenario around. What if the pound actually strengthens? Well, then your $10,000 becomes worth less in sterling terms. Right now, you could claim that drop as a capital loss to offset other gains. But once this new CGT exemption goes live, you can't claim that loss anymore. So you avoid the tax on those FX gains for sure, but you sacrifice the loss relief. It's a major trade-off you've got to be aware of. All right, Section 4, DeFi, no gain, no loss. This is all about fixing that massive 2022 dry tax problem. To really appreciate this fix, we have to look back at the absolute nightmare that was the 2022 HMRC guidance on DeFi. Honestly, anyone who tried figuring out their taxes for these activities knows exactly what I'm talking about. Under those old rules, just depositing your crypto into a smart contract, like a liquidity pool, could trigger a disposal. That meant you were hit with a dry tax charge. Basically, you had to pay capital gains tax on purely paper moves, even though you hadn't cashed out a single penny of real economic profit. Plus, the administrative record-keeping was just suffocating. The industry rightfully pushed back hard on this. Well, good news, HMRC actually listened. Their solution is this new no gain, no loss rule, or NGNL for short, and it's a brilliant fix. It simply defers the tax event. It finally recognizes that just shuffling your tokens into a smart contract isn't an actual economic disposal. With NGNL, you are not taxed until you actually sell or swap the asset for a true, realized economic return. So HMRC is specifically applying this new NGNL treatment to 3 distinct DeFi scenarios to finally rescue users from all that premature taxation. We're going to briefly look at crypto asset lending, crypto asset borrowing, and liquidity pools. First up, lending. Under these new draft rules, if you lend your crypto out to a protocol and eventually get the exact same type of crypto back, there is absolutely no capital gains tax triggered on the entry or the exit. It is treated totally seamlessly. So much better, right? Second scenario, borrowing. When you borrow crypto, you're treated as acquiring it at market value. Then, when you repay that loan, it's considered a disposal at that exact same market value, meaning zero capital gain generated. And crucially, transferring your collateral to secure that loan in the first place is completely ignored for CGT purposes. And finally, scenario 3, providing liquidity to automated market makers, or AMMs. Say you deposit some Ethereum and USDC into a pool. As long as you eventually get those same assets back out, the actual transfer in and transfer out is treated as no gain, no loss. What actually matters here is the token count. If you get hit with impermanent loss or gain, meaning you withdraw a completely different ratio of tokens than what you initially put in, that difference does trigger a taxable event. But importantly, it only happens when you finally exit the pool. So those wild currency swings while your crypto just sits there, they no longer trigger a tax bill all on their own. Wrapping up with Section 5, Practical Takeaways for 2027, How to Prepare Your Wallet. Okay, I know we've covered a ton of technical ground today, so here is your quick wrap-up checklist. First off, take a moment to celebrate. Record keeping for eligible stablecoins in DeFi lending is about to get significantly simpler. Second, that terrifying risk of getting hit with a dry tax charge before you've even cashed out, that is drastically reduced. But listen, you still can't get lazy with your tracking. You absolutely must continue diligently tracking your cost basis for the moment you make a real economic disposal. And finally, keep in mind that these new rules only apply to eligible stablecoins and specific DeFi functions. For your Bitcoin, Ethereum, and other non-pegged assets, all the standard capital gains tax rules are staying exactly the same.
And as always, here is our standard disclaimer. This explainer is strictly for educational purposes, and we are working directly off of the HMRC draft policy papers published back in July 2026. This is absolutely not financial or tax advice. Every single portfolio is unique, so please always speak to a qualified UK tax advisor to figure out your own specific circumstances.
To wrap things up, I want to leave you with a thought to really ponder. By removing the friction of capital gains tax on simple stablecoin transactions and Forex movements, the UK is basically paving the way for stablecoins to function smoothly as actual, everyday money. So, with stablecoins soon being treated much more like fiat currency, how is this going to reshape the UK's everyday crypto economy by 2027? Are we about to see a massive surge in real-world retail adoption? Let that sink in as you review your portfolios. Thanks so much for learning with me today, and keep exploring.